Hi, in this edition, let's talk about results. Let's talk about oil and its prices moving up, the impact on currency, the state of the markets, and of course, the result season that's still going on. To start with the result season, a few takeaways. The consumption part of the market continues to deliver good results, and the markets have been extremely supportive. Wherever a company has delivered good results in FMCG, durables, autos kind of a space, we have seen a sharp uptick in the stock prices. Results have been good also for metal mining companies. However, here the stock prices have not reacted so positively. This may be on account of unsustainability of the underlying commodity prices themselves, or because of risk of increased leverage, given that many of these companies are in the fray to acquire stressed assets under the HCLT. The big event of last month has been a sharp uptick in oil prices. Now, the fact that oil refining and marketing companies have been able to pass on the oil prices in quick succession. In this month, we have had 14 days of consecutive oil price increases, implies that the reform on pricing that the government initiated have stuck on. This is very, very positive and something that investors should be clued on. That said, higher oil prices do create a stress on the fiscal. However, over the last few days of the month, it seems the geopolitical tensions, which were one of the causes of oil prices moving up, are beginning to recede. The oil producing countries, some of them have talked about higher oil production to compensate for a potential Venezuelan decline, and that's helped cool off the market sharply. The currency markets had responded in sympathy with oil. Oil is our largest import, and when oil prices moved up, we saw currency depreciate very sharply. Given the fact that for 3 years now we have had a very stable currency, we do believe markets are in a position to withstand some amount of volatility. With the reduction in oil prices, we have seen currency reverse back its move towards the levels that we had seen over the last few months. Politics was in focus during the month of May. We saw the elections of the state of Karnataka. This was seen to be a precursor to the national elections. However, the mandate that was thrown out provided very little further insights into how the final national elections would turn out to be. FIIs continued to sell, and over the month of April and May, we have seen this. However, in the month of May, in spite of all the volatility that we have seen in terms of geopolitics, oil prices, politics in India, etc., markets have still continued to be very, very range bound, only a tad softer than where they were in the month of April. This is because the flows from the domestic investors continue to be strong, given the fact that as a asset allocation, domestic investors have very little into equities. We believe the strength in domestic flows will continue for a long period of time going forward. The mid cap part of the market, though, continued to remain weak. We had made a point that this part of the market is expensive on valuations, and the correction in this part continues. Going forward, we do believe that consumption is the part of the market where earnings visibility is the highest. Given the fact that the government spendings are high as a part of the budget itself, the fact that the monsoons are expected to be good, and also the fact that this year, apart from Karnataka, which has just happened, we have 2 or 3 major state elections followed by the general elections itself. The money is in the hands of the people should ensure that the consumption stays buoyant. A large part of our portfolio across our schemes is focused on the consumption theme. Thank you.